This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us right now around the table, Chris Harvey, Head of Equity Strategy at Wells Fargo. Good morning, Chris.
Good morning.
Would you like to start with the old price target or the newer price target? Because the old price target was 4,200 on the S&P. Are you more comfortable with that than the 4,420 that you upgraded it to?
No, we're okay with the 4,400, right? So at the beginning of the year, what we said is our base case is 42. 44 is a soft landing. Doesn't look like we're going to have a hard landing this year, so we just bumped it up to 44. The range that we think we're in is that 42 to 46. We think we're going to spend more time at the top end of the range. Right now, we're just taking some froth out of the market, repricing risk, and we're waiting to see when the bond buyers start to show up. All-in yields are approaching that 590 level that we saw back in October. CPI is down 200 basis points since then. It looks like the Fed tightening cycle is over, close to being over. Buyers should start to materialize. We'll see.
What I find interesting here is you're the single best qualified person to ask this question to. In your ute, you were out in the romance of 54-degree water, clamming in Long Island to pay the bills. I want to know, and this really works, where's your line in the sand with the equity markets right now? Where's the tension point that's the Harvey line in the sand?
You know, Tom, I'm going to, like all good equity strategists, I'm going to shift, and politicians, I'm going to shift because yesterday was really, really interesting. It brought me back to 99, 2000, because what happened? Interest rates went higher, old economy stocks went down, new economy stocks went up. That was so reminiscent of 99, 2000. So when you ask me for a line in the sand, I can't give you a line in the sand because the markets are not reacting.
But there was a march distant from that where there was a line in the sand for all of us, which is oops. How close are we to oops?
I don't think we're close to oops. What I think is what we're saying is 4,200, that's the technical level. We think that level holds. We have to wait for rates to kind of wash out here. There's been a lot of talk about rates, but we think you should start to see buyers showing up, especially those all-in buyers, pretty soon. The other thing we'd like to see is we'd like to see something from one of the Fed members saying something about rates in the back end, because I don't know, maybe John said this before, if you look at what's happened to the 10-year, right, since the issuance, since Janet Yellen said, hey, we're going to need a lot more paper, real rates have gone straight up, and real rates have dried nominal up. This has not been about fundamentals. And so we may have to wait until November to find out what the needs are in the short term. We find out in November that the needs aren't as bad, then we can find some ground, we can find some bidders. But in the interim, maybe one of the Fed members comes out and says something. We'll see.
Is the 4450 call that you have predicated on the idea of rates going down or just staying where they are and not moving as rapidly?
Really just what we need is we need stability. Rates don't need to go down from here. What we're seeing is the underlying fundamentals are still good. We just got through a period where we had a major conference season. We had pre-announcements. The pre-announcements were pretty benign. And so we think the underlying fundamentals are fine for now. So we just need rates to stop because if we don't know where the top in rates will be, we don't know where the bottom in the equity market is going to be.
That's important, Chris. You don't need them to go down. You just need them to stop going up.
That's right. That's right.
Are you seeing signs that tech leadership is stabilizing based on what you identified in yesterday's session?
I think so. So again, if we go back to yesterday, what happened? You had a lot of the defensives roll over, right? The defensives are rolling over because rates are going up.
Utilities.
Utilities. There's a lot of leverage in utilities, a lot of leverage in staples. Where are people running to? They're running to Uber caps. Uber caps are now seen as that safety trade. If Uber caps go up, the market goes up.
So is that AI or just all of the above? Everything that's in Uber caps right now?
Really, everything in Uber caps. What we do is we look at the Russell top 50, right? And you have AI, but really what you're buying is you're buying at a premium of 10 to 15% to the market, stable balance sheets, less volatility, better earnings with an AI kicker. And that's not bad.
When you say yesterday it was buy the new economy, sell the old economy, I thought that was really interesting, which raises a question, are we going to just get more of the same in terms of the dynamic of the Magnificent Seven or a basket of stocks that are leveraged to artificial intelligence and the new tech gains, really outperforming while everything else not only lags but loses value?
I think so. That's been our call. So what we've been saying is that we thought you'd have a broadening out of the market in the summertime, in the spring, but that was partly because people thought, hey, the economy's not going to be as bad as expected. What you need for small caps and mid caps to do better is a much stronger economy, and that's just not going to come to fruition. So we do think it's going to be narrow. We do think the uber caps are the ones that outperform.
Lisa, you asked the question exactly where I was, but I would narrow it even further to say technology, new economy that's profitable and displays free cash flow versus many of them that do not. Out in the zeitgeist today, Lori Calvasina is a percent of Russell 2000 that's not profitable. That's not Apple.
Just real quick here, as you're talking about this, we're seeing 10-year yields climb through intraday highs going back to 2007. At what point with yields, Chris, do you rethink your assumption?
Well, let's talk big picture on yields, right? So if you look at real rates, and let's just say we go back 2 decades, real rates, the high end is about 2%. If you look at inflation expectations or break-evens, the high is about 2.5. You've gotten above that, but not for a sustained period of time. I think maybe back in 06, 07. So 2.5 plus 2, as best I know, is 4.5. We're in and around those levels. Now we get to 5. Well, the components start to, then all of a sudden what we've been seeing is real rates going higher. Now the back end's a lot more restrictive. That's going to weigh on the economy. Ultimately, that's going to sow the seeds of bringing it back down. We can get to these levels, but what's going to happen is it's going to slow down the economy a lot faster, and then things will come back down once the economy slows down.
Hey, Chris, this was awesome. It's good to see you, as always. Chris Harvey of Wells Fargo on this equity market.
This is the interview of the day for Global Wall Street on where we are with bills, notes, and bonds. Robert Tipp out of Berkeley had a shingle out at First Boston a few years ago. Definitive at PGIM Fixed Income Chief Investment Strategist. Robert, why is this move in bonds different than the other 18 you've witnessed?
Well, there are similarities and there are differences. The thing that you don't see very often that we're seeing right now is a change of paradigm. We were in an environment for a decade, post-financial crisis, post-European peripheral crisis, where the central tendency for the 10-year Treasury was 2, and for the bond, it was around 0. And I think the Fed, is looking at the data coming across the transom. They're saying we need to be at 5+, and we're comfortable up and around this zip code. And I think that's because they are looking at the data, and the data is telling them that, 4 is the center of the range, and they need to have policy a little bit at the restricted end of the range until they get inflation down. And the same is going on in Europe, where they're going to be engineering a higher interest rate environment there. This is the end of the financial crisis, the end of the peripheral crisis, and return to a more normal level of bond yields.
I look at what PGIM does, Prudential, your work with Allstate for years, and it's about a shift in the actuarial assumption. What is the next institutional pension actuarial assumption look like? Is it 200 beeps higher from where we are now?
Yeah, I wouldn't worry about them. I don't think they ever fully adjusted to the low interest rate environment. I don't think the equity market's adjusted, but I think the financial community will do fine with this level of interest rates, the financial institutions. I think investors, though, and policymakers are getting dragged kicking and screaming to the new environment, especially the investors. The biggest pitfall, I would say, in investing is adaptive expectations. There's a lot of distractions with the cyclical noise, the government shutdowns, each economic region being in its own business cycle, having differences from the others. It's very hard for people to wrap their arms around that. And the Fed readjusted. They were one of the few institutions that started to believe a 2.5% nominal Fed funds rate was going to be the neutral forever. And now they're, on the precipice of starting to move back up. This environment was clear from early 2022 that we could be back in a 4, 5, 6% interest rate environment. I think that's the thing that people need to wrap their heads around here.
What you just said there, 4, 5, 6% interest rate, are you saying that the sell-off that we've seen in 10-year treasuries isn't done and that you see enough momentum and, frankly, rationalization behind the move that yields could go beyond 5% to even 6% on the 10-year?
Yeah, absolutely. I think that's not a base case, right? But if you imagine that the best news on inflation might be behind us, we have energy prices going up, we have a unique situation where high interest rates are crimping housing supply around the world, at a time when housing is in short supply. That's a very unusual configuration. You could get some bad inflation numbers. You could get a signal that higher rates are coming from central banks. And the curve shape is only ready for rates to come back down. It's not really ready for the higher for longer kind of idea that you could, as whether that's a 1 in 6 or 1 in 3, you could definitely end up between 5 and 6 on the 10-year. I think it's more likely we're going to head up towards 5. And then as we go through next year, thankfully, the fundamental data is really moderating. The underlying trends in inflation moderating, growth moderating. And in the U.S., less so than in other places, but even in the U.S., it is. This battle on inflation, as our economist Jon Ferro is fond of saying, is over. And we should be seeing the rates coming back down next year. But definitely, I think we've seen a move in that range, back up towards the central tendency around 4. And right now, the Fed's not convinced that this cycle's crested. So, yeah, there's upside risk.
Robert, you were talking about the inflation outlook. You're not talking about the fiscal backdrop, which a lot of people say was known, right, that we're going to have a real big supply of bond sales and not the Fed picking up the other side. Is that one of the main drivers, or is this just fundamentally the data's been coming in better than expected, and this is an economy that needs a 5% 10-year yield, not a 3.5% one?
Yeah, I think up until, the turn of the century, the supply bulges weren't that big. But since the financial crisis, COVID, the fiscal situation is huge globally. We're dealing with governments that have much bigger debt stocks, much more rollover. And we've just come into the QT period where that means the central banks are no longer coming in and scooping up big chunks of the auction. So the markets now are forced to think hard about where things are every day. And on a day like yesterday, there were no treasury auctions of long-term notes and bonds, but I think there was over $100 billion in bills. So there is a relationship there. It tends to make curves steeper. It tends to make treasuries cheapen relative to what's the true underlying riskless rate in the market. And I think that is one of the minor upward pressures contributing to this sell-off. We've seen that with the downgrade. We saw it with the refunding announcement. And the other big driver is the Fed that's dragging the markets, kicking and screaming to the reality that we're going to be up in this zip code, for rates for some time to come.
Not a zip code we've been in for a long, long time. Robert Tipp, thank you, sir, of PGIM Fixed Income.
The Conference Board is absolutely definitive on the pulse of business in America. Dana Peterson is the chief economist of the Conference Board. Dana, what's business doing right now with this yield move?
Well, I think businesses are looking at the fact that the cost of capital is rising, and they're starting to pull back on investments. And certainly when we look at our our CEO confidence measure, many CEOs, even 84%, think that there's still going to be a recession coming, and they're starting to think about what they're going to do with investments. But surely they are still holding on to workers, and they're still hoarding.
I look at this, and to me, and this goes to the Conference Board research, and that is the log convexity of this real rate, this new environment we're in. The rate of change, the speed of movement is shocking. Do you see that in the Conference Board research?
Well, I mean, certainly when we ask consumers what they're really concerned about, deep in the weeds, they are saying that they are concerned about higher interest rates and what that means for purchasing items, especially big ticket items that you need to finance. But the thing is that they're still mainly concerned about inflation, and certainly they're becoming more worried about the labor market.
The fact that there is more concern about inflation, that there is more concern about hiring enough workers, does that just sort of solidify to you that we are not going to get a recession in the near term, that we can keep going the way we are, just simply because they keep seeing the customers, they keep seeing the sales?
Well, I think we're seeing some slowing in sales. Certainly when retail sales came out in August, they were weaker. And I think the consumer is going to be faced with a number of hurdles. Certainly, just as of this weekend, student loan payments returned, and that's roughly 44 million people impacted. Many of those people are between the ages of 35 and 49. Those are peak spending years. And so when you add that on to the fact that excess savings is running out, many consumers who already spent that money are turning to credit card use. All these things bode poorly for the consumer. And certainly with higher interest rates, still yet to impact the consumer spending. We think that we're still headed for a short and shallow recession, probably in the first half of next year.
The key component that we've been looking for is the labor market. We are going to get the JOLTS data coming out at 10 a.m. today. There is a question about whether some of the wage increases that people will keep seeing will offset the inflation, will actually be real positive wage growth, which we actually started to see in the past number of months. Do you foresee that being the new reality just because of the structural tightness of the labor market?
Well, you have two things going on. Wage growth is slowing, especially in services, not so much in those jobs where you have to physically show up to work and you're losing older, experienced workers. But inflation is coming down, at least underlying inflation. And so there is an offset. And for the first time, we've had several months of real wage gains. But still in all, when we ask consumers, what are you most worried about? They're still complaining about food and energy prices. And we know that energy prices are rising because OPEC has pulled back on production. And so that's a bread and butter type issue. And for many consumers, it doesn't matter what's going on. If it costs more to fill up your tank and it costs more to fill up your grocery cart, then the world is not a great place.
This is the reason why some people are worried about a wage price spiral, because you're seeing the activity of labor unions coming out saying we're not keeping pace with those increases at the pump, with those increases at the grocery store, and they're demanding higher wages, and they're getting them. How much are you watching this with interest to highlight how much we could see wages continue to go up at a significant pace, just simply to offset that pain that you're talking about?
Sure. I think the key thing is that the number of people who are in unions now is much lower than in the past. So I don't imagine that the actions that we're seeing and increases in wages due to union actions are necessarily going to spiral out of control and filter throughout the rest of the economy. But like I said, we are seeing wage growth slow. Last year, wage growth was really outsized, more than it could be sustained by businesses. So we're going to see that slow to a more sustainable pace.
Dana, what are we going to see in the jobs report? I'm asking for a friend.
Well, I don't know what the numbers are, but I would not be surprised if we saw continued slowing in the number of payroll gains, certainly compared to last year. Just looking at the three parts of the labor market, you're still going to have a lot of hoarding, but we're probably going to continue to see job losses in those sectors that did very well during the pandemic and are not doing so well now. And then also some continued gains in healthcare and some in leisure and hospitality.
Yeah, Neil emails in, he says, but what about the real wage? Okay, so you got the doom and gloom Dana Peterson wage decline, I get it. But I also got disinflation. Do I have a level or even an increasing inflation-adjusted wage?
Well, I think, it depends on your inflation gauge. If you use headline, it's probably about level. Or maybe even it declined a bit because, like I said, overall inflation is rising because of gasoline prices. But if you use the core, then you probably will see some easing, or rather some improvement in real adjusted wages.
Dana, thank you so much. Dana Peterson with the Conference Board here on the American economy.
As new weight loss drugs hit the market, Sheila Kahyaoglu of Jefferies crunching the numbers and writing this: United Airlines would save $80 million a year if the average passenger weight falls by 10 pounds. This would trim 1,790 pounds from every United flight, implying a saving of 27.6 million gallons a year. TK, there's some big numbers.
This is important. Jon Ferro, bring in our next guest. Jon, I'm going to do some research for you. My father died, and I had to take on very short notice an economy trip. I didn't have a choice. Get on a plane, prima donna like I had to go to economy. And I can report to you with surveillance analysis, which is appropriate for someone who owns electrical equipment at Credit Suisse and now at Jefferies, Sheila Kahyaoglu, that the economy width of a United seat is 16.8 inches and business class is a lofty 20.7 inches. I had to sit up the entire way to Oregon.
On the armrest.
Because I literally couldn't get in a seat.
TK, that's
joke.
Brutal.
It's worse than Fenway Park.
That's brutal. Sheila, I'm pleased to say, is with us now. Sheila, good morning.
Thanks.
Let's start here. How did this study start? What are you assuming? What are the underlying assumptions that go into all of this?
So kudos to the Jefferies Equity Research Department for pulling this piece together with 30 analysts across the department, and of how weight loss drugs could potentially be helpful and impactful to industries. And for aerospace and defense and airlines, airlines are constantly trying to save fuel. Fuel is 25% of their costs. It's something out of their control. Fuel is up 30%. The stocks are down 20% in the last 3 months. And the engine manufacturers like Raytheon, Pratt, and GE are having trouble getting the fuel efficiency across. So we said, what if something out of their control happens and 175 people on the flight lose 10 pounds because of Ozempic or whatever, diet that they're on? And what does that do? And we took a stat going back to 2018 that poor United Airlines put out there. They saved an ounce on every passenger seat from changing the feedstock of the paper that they used on their United Airlines magazine, and saving 11 pounds per flight.
What?
Yeah, and so we extrapolated that into 10 pounds per passengers, 175 people per plane. What happens to the fuel savings? They save $27 million. Versus the $42 billion that they use. So they use a lot of fuel, and it's only 2%, but hey, it's a savings out of their control, and you don't need a new engine for that.
So this is a what if. Are you prepared to say that this is a proxy now for Ozempic and we should get long United Airlines? Are you there yet?
I think across the airline space, variable costs is very difficult for them to manage with fuel going up. So in all seriousness, that is impacting shares of the airlines so far. Labor costs are up 40% as well. So with 50% of their costs up significantly over the last few months, it's definitely weighed on the airlines. And we're going to see that into Q3 earnings that are coming up in 2 weeks' time. But, the cost element is weighing, and also the revenues are as well because of pricing problems.
Lisa had the surveillance Gulfstream on her last soiree. I had to go back and actually Scott Kirby, Air Kirby, United Airlines. I was thunderstruck at the percent of business class seats. The more I look back, it's bigger and bigger. One study is they've gone from 30 seats to 46 seats. When is the time where business class simply takes over their profit proposition?
So what's going on in the airline industry right now? It's the haves and the have-nots. For the first time in such a long time, the network carriers like United and Delta are having their way, because that premium passenger is holding up the pricing element, and the mainline cabins are actually seeing price deceleration year over year and overcapacity to leisure markets like Florida. So you're really seeing a tale of two markets where Southwest, JetBlue, are pre-announcing pretty negative results on their visibility, and Delta and United are seeing premium pricing happen. So that's because of the business class.
Let's put that together. This idea of the potential for weight loss to improve the margins for some of these companies, and the idea that a lot of the companies are earning the most from the front of the cabin. How much can they really push in terms of extra expenses before they have a real PR problem? In other words, what would happen if you had a company come out, one of the discount carriers, and say, we're going to weigh everybody before they get on the plane, and if you're over this point, we're going to charge you more?
I think that's part of the problem with the discount carriers is, there's no seat assignments. It's a lot more difficult. There's no variability in the class you sit in. So I think we're far away from weighing passengers, but this was just,
We weigh bags, don't we?
Yeah.
Well, they weigh bags. You get punished if your bag is too heavy. Don't you?
Well, okay, but this to me is the issue. It's like, how much can people handle? How much can people put up with? Paying for water, paying for drinks, paying for snacks, paying for the air you breathe, paying for how much you weigh. At a certain point, when does this become a real problem?
That 10 pounds of weight loss, where does that 10 pounds come from? Are you making assumptions of what could happen to the average weight of the passenger? Do you think that's something that actually could happen?
Yeah, I think according to these weight loss drugs, clearly I'm not on them, but people tend to be on them. But if they do lose an average of 10 pounds, 175 passengers per narrow body, wide bodies are 300. It would be a significant fuel cost savings. And it was actually in light of, because we cover the airlines, the aircraft OEMs like Boeing, and the engine guys like GE and RTX, and they're having such mega issues building these aircraft. It was just a fun way of looking at something that's completely out of their control, not having to do with making a fuselage with Spirit. That stock's down 45%, just changed its CEO yesterday. And the engine manufacturers, obviously, Pratt is having a tough time with the contamination in their engine. So it was a different angle of looking at something completely out of their control.
JetBlue's struggling as well, so let's get to the nuts and bolts of what's happening right now. Are you starting to see limits to the consumer appetite for flying domestically in America? Are we seeing that happen now?
So it's a matter of, that's our debate in Q3. We're going to see what results have to bring. We downgraded Southwest Airlines to an underperform in the beginning of August on that structural call, that the U.S. domestic consumer is in a tough spot. Student loans are coming back. It's weighing on their savings, so that mainline cabin passenger is going to see some difficult times. Pricing is up about 10% versus 2019 levels. We saw Q2 pricing on the mainline cabin down 1%. Very different than the story we're seeing in the premium business class cabin. Very different than transatlantic, up 25% versus 2019 levels. So it's a matter of where what we see in Q3 results.
John, I look at two flights. I just ran through the Paris flight, which I think at one point was $7,000, even $9,000 in pandemic and all that. Shocking statistic, $2,612 business class to Paris out a couple months, like when you're planning months out. Economy used to be $700, even $900. It's now $534, but the ratio is still 4.9 to 1. You pay a premium to fly Ferro.
You pay a premium, just to be clear.
Okay,
just to be very clear. Sheila, thank you.
Thanks, guys.
Sheila Kahyaoglu of Jefferies.
With the support of Ray Dalio in Greenwich, Connecticut, they have put together an annual soiree come October. The Greenwich Economic Forum, really can't say enough about that. Behind that in support is their governor, Ned Lamont. He is the governor of Connecticut and, of course, has a storied history here of doing business and attempting to keep business within Connecticut. Of course, all the idea of the transfer of Connecticut to maybe a greater New York business as well. Governor, thank you so much for joining Surveillance this morning. What are you going to do about Florida? What are you going to do about somebody in an X million dollar palace in Greenwich or someplace else, or somebody in a $122,000 rental paying $4,000 a month in Connecticut, and both these people say, I'm moving to Florida? What are you going to do about it?
Good to see you. First of all, this is not a soiree. This is a hard-working group for the Greenwich Economic Forum. We have a lot of fintech and financial services here, expanding here, moving here. You're right, though. A lot of these firms also have a foot down in Florida, so there's a little bit of a competition, Greenwich and Stanford and Miami. When it comes to housing prices, we're very competitive. When it comes to workforce and, young, well-educated folks ready for the fintech world, Connecticut is very competitive there. And we've had tens of thousands of new families move into the state of Connecticut, in each of the last few years. So I think we're making progress. A lot of people want to be here.
What is your most effective tax policy over the next 5 years to compete with the American South?
Did you say tech or tax?
Tax, T-A-X, tax policy. Connecticut, I don't know if you're aware, they have a few marginal taxes, to say the least. What are you going to do about tax policy in Connecticut?
Well, look, I don't think we'll ever be as cheap as Florida when it comes to taxes, because they can tax sunshine and tourism. But we have an amazing education system, which is a big plus. We just reduced taxes for everybody earning up to about $250,000. So we're the lowest in the region. So we're making real progress there. We've eliminated the estate tax for everybody except for the very top 5% of people. So I take that to account, but I also have to sell Connecticut on the attributes. And that's not just the lifestyle. That's not just the easy access to New York or Boston. Great place to visit, wouldn't want to live there, but also the quality of our education system and our workforce.
How difficult, Governor, is it to really build up Connecticut at a time where you are losing population, when borrowing costs are where they are, where you don't have the leeway of borrowing to build so that they will come?
Well, look, let's face it. We were flat as a pancake for 30 years there. And you're absolutely right. We were losing population. A lot of the older folks were going down to Florida. That's turning around a bit. During the COVID days, our schools were open. A lot of folks moved into the state. A lot of them came from New York, to be blunt about it, and they stayed. So our schools were expanding. The biggest shortfall I've got is housing. I got to make sure we have enough housing for people here.
There's a problem, though, with businesses. I mean, Frontier Communications was the latest, going to, I believe, Dallas from Norwalk, Connecticut. I mean, some businesses are looking for that tax advantage as well. It's not just older people in particular. I just am wondering how much you can really cater to the tax side of the equation when you can't plug the gap on the borrowing side simply because of where yields are.
Well, I can tell you that Frontier, which was newly bankrupt, did move their corporate headquarters, but all the staff is still here. But Citadel and Apollo and Digital Currency Group and Tomo all moved to the state. We're taking sort of an older economy and slowly moving into a newer economy. So I like the trend there. You're absolutely right. Look, taxes is a variable. New England, Northeast is more expensive than the Sun Belt, or as I call it, the Hot Belt. But we're getting more competitive every day, and I think our workforce is a big advantage.
Governor, do you have a migrant crisis?
No, I wouldn't say it's a crisis, but I watch it carefully. We've had a few thousand migrants come. We have a bit of a waiting list, but for us, a waiting list is going from 3 weeks to 3 months. It's not what it is in New York and Texas. But we watch it carefully. They've got to get control of the border. That's just the deal.
You're a sanctuary state, aren't you? Am I right?
No, that's not true. But we do have a couple of cities that claim that. But this is not a sanctuary state. We do take care of people in need when they come to the state. But again, I think that said, we've got to get control of the border.
What do you make of the attitude changes in places like New York, where a year or so ago they were welcoming migrants and people seeking asylum, and now they seem to be turning their back on that? Now they actually have to confront what that looks like.
I think a moderate is a liberal who is bugged by reality. When New York City has hundreds of thousands of new migrants you got to take care of, you got to shelter. Kathy Hochul's been very outspoken on this, as has Eric Adams. Got to get these people, if they're there, you're either going to be on welfare, they're going to have to be able to get a job. It all circles back to the fact that you got to control your border.
So are we saying, Governor, that what we saw for much of the last several years around this issue was purely just virtue signaling without a price, and that it had now been mugged by reality?
Well, let's face it. We've had a lot of migrants coming across the border, going back to Donald Trump and caravans of terrorists or whatever he said. But that said, we got to control that. Part of that is what you do at the border. Maybe you recognize Venezuela and do some things to mitigate the pressure for people wanting to come into the United States.
Ned, I'm absolutely thrilled to find how we're going to save banking in the Northeast. As you know, you had 6 football field platforms of UBS long ago and far away in Stamford. And that's it's not that it didn't work out, it's just technology advanced forward. With work from home, with technology, how does Connecticut stay financial?
I think work from home, Tom, is a good trend for us in the sense that we used to have everybody commuting back and forth and into the city and down to Wall Street and the long haul. And then, as you point out, a lot of them wanted to be closer to a home, so they moved some of their headquarters out here. But what we're finding is maybe you're in the city 2-3 days a week. Our Metro North trains on Friday are not crowded at all. In fact, they're virtually empty. We're going to cut down there a little bit just because people have a different lifestyle. But I think the fact that you can be closer to home out here in Connecticut, and you don't have to do that commute 5 days a week is a big plus for the Connecticut lifestyle.
Governor, appreciate the update today. Let's do this again soon. Governor Ned Lamont there of Connecticut.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.